The Reserve Bank of India has kept its benchmark repo rate unchanged at 5.25%, signalling a cautious wait-and-see approach even as regional peers tighten policy. Inflation is above the 4% target, driven mainly by fuel prices. Yet the RBI remains confident that core inflation is cooling and growth is holding firm at 6.7%. With the rupee under pressure, foreign inflows surging past $41 billion and credit demand running hot. Well, the big question now is how long can the RBI afford to stay on the sidelines? And joining us to break this down is Joshi, Chief Economist at CRISIL. Well, thank you so much, Mr. Joshi, for joining us.
Glad to be here.
Right. So let's start with the inflation picture. Now, headline inflation is above 4%, but core inflation is easing. So, Mr. Joshi, is the RBI right to hold at 5.25%, or is it gambling that oil-driven price pressures won't spill over?
Well, I think this is the stance and the policy action which is holding everything steady was the right approach at this juncture. I think for several reasons. The inflation is going to be higher than what it was last year. So don't forget that last year inflation was just 2%. So there's a very strong base effect. And on top of that, I think we also seeing the monsoons have been somewhat better in the month of July than what was predicted. Even there is some talk of thawing as far as the West Asia conflict is concerned, and that has brought the crude prices down. So and also there is no generalization of inflation so far. Generalization means that the supply shock gets transmitted to core inflation. Core inflation is quite low. So it was 3.9% in June. If I take precious metals like silver and gold out, then it was just 2.5%. So I think they could afford to wait and watch in this scenario, which is quite uncertain. And I think the policy in this environment remains data-driven. As you get newer information, you accordingly take actions.
Right, Mr. Joshi. Well, the RBI has cut its inflation forecast to 5% and lifted growth to 6.7%. So which of these numbers do you trust more, and what data would make you flip your view on this?
Well, I think we also are in the business of forecasting. Our forecast for growth has been for the last 3-4 months at 6.6% for the current fiscal year. And inflation is at 5.1%, which is fairly close to what the central bank is predicting. So we are aligned to the forecast that the central bank has made. Now, having said that, I think at this juncture, the risks to the forecast, as I was mentioning earlier, seem to be balanced. But it's an uncertain scenario. You'll have to keep an eagle eye on the incoming data, and then accordingly revise your number if that is needed. So, and I think overall, as far as growth is concerned, there will be. The headwinds are clearly two. One is the monsoons, which could turn adverse because the El Nino is very, very active. And second, I think, is the West Asia conflict, which has been seeing escalation, de-escalation continuing. So it's very hard to predict where it will go going ahead. Having said that, I think there is some support to the economy also from the government spending side, which direct benefit transfer payments at the state level, the capex support that government has been giving. I think all these things do hold the economy. They cushion the economy. And even last year's income tax rate cuts, and on top of that, the GST cuts are still flowing into the economy. I think they're creating support. So I think overall, I would say, I think both growth and inflation seem to be close to what we are also saying. So we are quite aligned to that.
Right, and going over to oil now, if crude stays elevated due to the West Asia tensions, which you just mentioned, so how quickly could that feed into India's CPI and growth? And at what oil price level does the RBI likely shift from, wait and see to actually act on it?
Well, I think RBI will not react to the level per se. I think they will more react to whether it is getting transmitted or not. And I think here you have it's not automatic transmission in India, as you know. The air turbine fuel and many other elements in the industrial sector will see a quick pass through. But as far as the petrol and diesel are concerned, I think they are in a way regulated. So we have seen seven rupees, 7.5 rupees increase in the prices. So, but what happens is that if the prices of crude oil rise and much more, and they stay higher, then I think there are three agents in the economy which bear the burden. One is the consumer. The second is the government, because it has to provide subsidy at times, and the third is oil marketing companies which suffer losses. So right now, I think the pressure from oil has been distributed among all the three agents. So if higher oil prices would mean higher pressure, I think whether government decides to push on it or it is passed on to oil marketing companies or to the end consumer, I think that will shape how the inflation plays out. I think at the consumer level, so to speak.
Right, but we have seen reports, stating that because of the West Asia crisis and the oil prices being expensive, like crude oil prices can go up to $120 per barrel. But do you really think that, these Indian oil companies are actually suffering losses because of all of this? And do you think that government is actually shielding consumers here?
Yeah, they are shielding consumers to some extent. They're not entirely shielding consumers. I think some of it has on. I think the airlines become expensive. The transport costs go up when when fuel prices rise. So I think there is some transmission which is automatically happening, some transmission which is getting regulated. So it's getting passed on to the end consumer as well. I think because you need a demand response after all. I mean, if people keep consuming, if the prices don't go up, I think then that will create more stress on the system, and because you'll have to keep importing at higher prices. See, our forecast for oil, the number that we are working with is 82 to 87 range. Currently, it is below 80, but I think as you've seen, it keeps flipping up, and I think depending on how the West Asia conflict plays out. So I think overall, with 82 to 87, I think we can bear that burden. I mean, so to say, and inflation can also remain under control with that kind of price.
Right, and with the BOP surplus, and it is over like $41 billion in recent inflows, the external account looks very comfortable at this point. But the rupee is still down 5.4% this year. So how much currency weakness is acceptable before it becomes a policy problem? Because you've seen recently just now, the Washington intervention for yen. So is it really somewhere, what are we actually looking at?
Yeah, so I think let me just give you a bit of a historical perspective. If you look at the year 25-26, I think we had a very low current account deficit, which is pretty much in the safe zone. But the capital inflows had dried up because India, one, because of valuation concerns in the Indian equity markets, and also second, because India was not a part of the AI story that I think is investment story that is playing out globally. So you saw dearth of capital inflows from abroad, and even a small current account deficit could not be financed. And as a result, I think rupee came under pressure. Now, what the RBI and the government have done of late, I think they have created avenues for capital to flow in through FCNRB deposits, and I think they have also made it easier to invest in the bond markets by getting rid of the withholding tax and capital gains tax. I think all these are bringing money into the economy. So even though the current account deficit is going to rise from 0.6% of GDP in 25-26 to 1.5% of GDP as per our estimates, I think its financing will not be that much of an issue, because you're getting a lot of capital via these schemes. And as a result, I think rupee will see more stability this year than compared to last year. I think the scheme was introduced because I think there was dearth of capital and the rupee was under pressure.
Right, and Mr. Joshi, what would trigger the next RBI move? Would it be a breach of the 6% inflation tolerance band, a sharper growth slowdown, or external pressure from the Fed and regional central banks?
Well, I think the others, every central bank is acting according to its conditions that are prevailing. Some central banks have raised rate. ECB has raised rates, but the US Fed decided to hold rates, although it was a little hawkish. Many emerging market central banks have also raised. So I think it depends on individual country to country. I think as far as the India goes, I think we are in a reasonably good shape and we can hold on raising rates right now if this scenario continues to play out. But I think if the monsoons turn out to be deficient and the second half of the year sees a dry spell due to due to El Nino conditions which are prevailing, then I think that will create some pressure on the food inflation side. And if West Asia conflict doesn't end soon, then that will also keep the oil prices high. I think in that situation, the costs become higher, and the companies also are going to pass it on to the end consumer, and then inflation shows signs of becoming generalized. But that is not the base case for us. That is a situation where I think where situation completely flips, I think, as far as monsoons and as far as the West Asia conflict is concerned. And we see more intensification of these risks going ahead. But I would say that's a tail risk right now. That's not a base case for us.
Thank you, D.K. Joshi, for breaking down today's RBI decision, the inflation watch, the growth resilience, and the delicate balancing act on the rupee. It was nice having you here. Thank you so much.
Thank you very much for having me.